Okay, we are live. My name is Thomas Minert. I'm an agent with Remax Precision, and I'm also part of the Sphere real estate group. And this is Thomas Talks on Thursday. This is a weekly live stream that I do to keep buyers, sellers, and people that live in the Des Moines area informed about what's going on in Des Moines, what's going on in the real estate world, and have you have a better idea of what it's like to have a conversation with me. And it is live, so you can participate in the conversation. I want to talk about what you guys are interested in, what you guys want to learn more about, whether it be real estate transaction stuff, places to go in Des Moines, or just any detailed question you have. That is why I'm doing this live stream every week. One of the things that I think is most interesting to future home buyers or maybe move up buyers, and one of the biggest reasons I see people not apply to get a home loan is credit score. They are worried about their credit score. So today I want to introduce to everyone watching Peter Eggers. And Peter, you want to take it away? You want to introduce yourself?
Yeah, no, that'd be great. Thanks, Thomas, for having me on today. Like you said, there's definitely a lot of confusion, and when a lot of new home buyers out there, when they're trying to purchase, one of the big questions they have a lot of the time is about credit. So I'm glad we're able to talk for a few minutes on here today. And any questions, like you said, if people have them, put them in the comments for Thomas, and we'll try to address those. But my name's Pete Eggers, so I'm the owner and CEO of Dream Home Credit Repair. So we do full service credit repair for clients, starting off with a free review. So if you ever have any questions, like Thomas said, on any type of credit questions, or if you want someone even just to review, what's going on with your credit, we do a free review. So we can always check that out. We can do a soft credit pull, so it doesn't hurt your score at all. Won't impact that. That's a myth that people always have. So we can always review it, get you home buyer ready. I always recommend, if you're going to be purchasing a home, start soon. It's a preparation game when you're trying to get a mortgage and you're trying to buy a house. Don't be in panic mode, which I see a lot of buyers do, especially first-time home buyers, where they'll come to me, I want to buy in, a month from now or 45 days from now. And really they need to try to plan a lot farther out than that, ideally 90 days to at least 180 days. So if you're trying to, have a ideal credit score, if you have stuff to work on. So after we do the free review though, I always go through with my clients exactly what's on their credit reports, do a lot of education. That's what I'm focused on with our company, is just making sure that all of our clients and people that come to us from realtors and lenders, that they know exactly what's hurting their scores and why, because you don't want people falling back into the same traps that they were just in. So we want to help people long term, not just maybe get a home, but more financially put themselves in a better place, because not having good credit not only can not let you get qualified for a home, but just makes your financial life much more difficult in lots of different ways. So, doing that full review and going through how we can help people, that's really what we're all about here in education.
Okay. And how long, just to dive deeper into the service, how long does
Yeah.
it normally just take, as long as it needs to take? And then what are the costs of that? And then what types of clients, is it the types of clients you're getting? Is it people that are normally just curious, or is it people that are in a pretty tight credit situation?
All the above, I would definitely say to that. So a lot of clients come to us, when their scores are in that 550 to 640 range.
Okay.
They're most of the time first-time home buyers that are trying to get a place, or like you said, they're purchasing their second home or third home, changing, moving, and they're working on their scores. Because when a lender looks at your credit scores, the loan programs are based not only off your debt to income and other factors, but credit is a massive piece. So if you don't have the credit, you're not going to get approved. So definitely we see a lot of first-time home buyers, but we also see people that are refinancing. As rates go down eventually, we saw a nice little uptick in that when rates did dip here earlier in the year. So what I would say is, when you're trying to get approved for a home loan, FHA loans for the 3.5% down start at 580. You might not get the best rates, but at least the door is open for you at 580. But most of our lender partners, they want to see the scores at 620, 640. So now you have a conventional home loan that is available to you. So usually when we do the review, most of those clients have 5, 6, 7 collections. They have some charge-offs. they have credit cards that they need to be coached on, or they don't have any at all. So we'll give them tools to get some new secure cards open up to build credit. And then what I do is work on the back end, either challenging stuff they disagree with to get stuff removed, or removing inaccurate items, because a lot of people have stuff that's not correct on their report. And then just as importantly, if not more, is doing settlements to help people get collections and other items removed too. So usually it's a 3 to 4 month process is definitely what I'd say is the average, but you're going to see scores improve within, after 30 days or so. So if you're following the game plan, if, you're adding new trade lines, if you're paying some down, if you're getting stuff deleted by settlements, you can see scores definitely change, 30 to 45 day mark for sure.
And that's actually a lot faster than I thought. Do your services cost different depending on what the client needs?
So it goes on, what I'm working on. So if there's, 5 or more items, then typically we have pricing plans, but we'll charge $359 on the 30th day of service. There's never anything up front. That's against a lot of charge upfront fees. So that's always a red flag if you're working with companies that try to charge you up front. So nothing until day 30 of service to get going. So you have time to save up if you need to. We do have payment plans, so we can go over those if someone has an issue. So our big thing is to help our partners. So the client's always number one, our realtor partners, our lender partners. We're really one big team, because everybody wins in a situation where, a person wants to better themselves financially. That's the goal, is to help them get their credit up. So not only could they get into a home, they're saving money on their insurance. They're saving money on, interest rates. They're saving all types of money on different other items outside of the home loan as well. So it's like, we just want to make sure that we're helping those people get into something. But in addition to first-time home buyers, there's people that have decent credit scores in the mid 600s that want to get to that next level for pricing breaks. So if you get to, let's say you're a 640 something, if you get to 680, that lender might be able to get you a little bit cheaper loan. If you get in the 720s, 780s, now you're getting into the top bucket, I like to call them, where you're going to have the cheapest interest rate with the lowest mortgage insurance.
I have kind of an idea of this, but I don't actually know the number off the top of my head. What is typically that credit score that can get that par, that best interest rate from a lender?
So it used to be 740. Things are a little bit tighter now. And again, talk to your local lender. But 780 and above is going to be, where you want to be if you want the best rate. But again, I wouldn't focus too much on that, especially when fixing credit. The goal is really that 640 and above gets you into a home. It gets you a conventional home loan for 3% down for a first-time home buyer. So that's really the big thing. As you get higher, you're going to save an eighth of a point. Who knows? A little bit more. But the big thing is focusing on that 640. Get yourself all the options of loan types. You could always work on credit and refinance down the road too, which we have clients do.
Yeah, that's awesome. So let's go to this next. There's multiple different factors that go into a credit score. Do you want to kind of break down all of those factors and how important each one of those is?
Yeah, for sure. I'd say the two that you really want to focus on is payment history. That's going to be number one. So we're going to focus this conversation. We can get into this a little bit, the differences of type of credit scores, but let's focus on the FICO credit scores for right now that have been used for decades. So TransUnion, Experian, and Equifax, the 3 major bureaus. When you go to get a home loan, your lender is going to pull a tri-merge report, which means they're going to get a score from each of the major bureaus. They're going to take that middle score and qualify you based on that middle score. So it's important, when you're looking at credit, don't just look at, Experian or look at TransUnion or Equifax. You got to look at all 3, because the lender is going to use that middle score or the lowest of the 2 if they take 2. So basically, what we're doing then is we're looking at these scores going, okay, what makes up the FICO score? Because we're not going to use the Vantage scores that you see on Credit Karma. We're not going to use the FICO 8 and FICO 9 different versions, that you might see at your bank or on your credit card app. They have to use version 2, 4, and 5. So what that can consist of is a few things. Payment history is 35% of your score. Do you pay your bills on time? Are there collections? Are there charge-offs? Do you have late payments? That's, going to be the most important piece of the FICO 2, 4, and 5 version. So the goal I tell people all the time is to avoid anything that could really drop the score, get stuff on auto pay. because you can't afford having 30-day late payments. That's not okay when you're trying to build your credit. I tell everyone it seems simple, but you have to not have 30-day lates because that can drop you 30, 40 or more points sometimes. That's going to impact you for 24 months. That's not a quick fix overnight. So you just got to put everything on auto pay if you're in the home buying process. Make sure it doesn't matter if it's a $20 late payment or if it's a $2,000 late payment, it hurts the same. So that's kind of step one. People come to me all the time like, I didn't have this I missed this little payment on this credit card. It was only $35 though, so that shouldn't hurt me, right? No, that's going to hurt you the same, minus 30, 40 points, which you're not going to be able to get back. You have to let time heal.
Is that one of the more common traps that you see that you mentioned earlier that is like a common mistake people make is just slipping up and missing one small little payment?
Yeah, I see it every week. I mean, it's unfortunate. People will call me and say, I had a guy yesterday that's like, oh yeah, I forgot to pay that, or, it was someone else put this on there, wasn't aware of it, or my debit card, I got a new debit card that was tied to this and that didn't go through. But you're usually going to get multiple notices by these creditors. They're not going to put it on there if it's 1 day late, 10 days late. It's got to be 30 days late. So You just got to stay on top of the game. Don't have any payments go 30 days past. So payment history is the most important. So that's why when we're fixing those negative collections and items, with our service, that's the most important. The second biggest piece is credit card utilization. So FICO says that can make up anywhere from 25 to 30% of your score. And what that means is how much of your available credit on individual cards are you using? That's the most important to start. They will add them all up eventually, but the most important, they're looking at each card individually. So you have cards, let's say the first one's $1,000 limit. So you want to stay below 30% utilization or usage on that card. So what you're going to do is divide my balance, let's say it's 300 divided by 1,000, that would give you the 30%. So you want to keep the balance owed below $300 at all times, so you're getting positive points. As you go over that, just because you pay it on time, that's the thing people get confused on. They think they can have their cards almost maxed out, but as long as they pay them on time, they're good. And that's fine for payment history, but not for credit utilization, which is the second biggest piece. So you got to keep all cards down below 30% minimum. To get the most points out of your cards, I would keep a small balance below 10%, actually. That's going to maximize how many points, but that's if you're really trying to squeeze out those last few points. But overall, I tell people on here, below 30% is great. Get to that first on that.
And I've always been curious about this. How are they checking in on that? Is that something that the credit unions, is it just random, or when they're checking in on your credit balance, how much you owe and how much your total credit limit is?
Yep. So what they'll do is once a month, you can pull your credit, whenever you want to pull that, any day. But the creditors are only sending their data in once per month. So it's not on the first, it's not necessarily on the 31st. A lot of people think that as well. It's very random days. So for instance, I have multiple cards. The data for credit cards is reported on what's called the statement closing date, which is not your due date. Those are two different things. So the statement closing date is the end of a 30-day cycle that your card's been open. They're going to calculate your interest, tack that on, and they're going to send that balance and your limit into the credit bureaus on that day. That could be on the 1st. It could be on the 5th, the 12th, the 15th, the 27th. And I'm telling you those because that's when mine report. So I know for a fact the statement closing dates are all over the map. So I have clients come all the time that tell me, oh, I already paid that down. How come it hasn't reflected on my score yet? And then I'll tell them it's not going to reflect until a few days after that statement closing date.
Okay.
So that's, credit utilization is the second biggest piece. So if you take, 35% and 30%, that's 2/3 of your score. So those are the most important. The other things you really can't control too much, but credit mix, is a small percentage of it, 10%. New credit is 10%. And then credit length is something, again, you can't really control too much of it besides start as early as you can building good trade lines. So I tell parents all the time, if you have kids, as soon as they can get a credit card, opened up or even a secure card for a few $100s, do it. High schoolers, and definitely once you're in college, get 3 or 4 cards opened up, because you're going to be able to keep those open for decades. Even I have credit cards from when I was in college that have built these long trade lines now. So for, many, many years. So definitely you want to start as soon as you can. But the things you should focus on are payment history, which is getting rid of negative items. That's what we do for credit repair. And then credit utilization. So if you have cards, keep them below 30%. A lot of my clients don't have anything. They've been charged off or they've been closed. So we'll open up, 2 or 3 new ones with a secure card, so we can start building those points again.
Does being added as an authorized user help?
Yeah, definitely.
Yeah.
Yeah, that's always a good strategy. If you don't have any cards, or if you just have one, sometimes if a significant other or a spouse, a close family member, somebody they might allow you to be an authorized user where you can kind of piggyback on their credit. So they might, instead of opening a brand new card, which would start at month 1, 1 month reporting after 30 days, they might have a card that's 5 years old or 10 years old. So now you're getting that payment history. The main thing you want to be careful though of is ask that person, are the balances low? I just saw someone the other day, they're on their wife's Discover card and there's a $9,500 balance on a $10,000 card, and they're working on getting a mortgage. Now it's a simple fix. He was able to get removed from his wife because it wasn't a joint account. But having an authorized user on there doesn't necessarily always help unless it's a low balance and you want it to be open for a while too. So, but definitely fantastic option, to be added to a card or two if you're trying to build credit quickly.
Let's talk about, so that's all the parts of that go into the credit score, correct?
Yep. So 35%, which is going to be the payment history, 30% utilization, 15% is going to be the length of time. And then credit mix is just, do you have, some installment loans like an auto loan payment or a student loan where you're paying the same amount over time? They like seeing that. The credit agencies do. They want to see that, and as well as 2 or 3 at least credit cards or charge cards with revolving lines of credit that the payment changes, goes up and down based on your balances. So you want to have a nice mix. That's why if you don't have any credit cards, that sounds good in theory because you're not paying any interest, and financially that's smart. But when you're trying to get a loan, they want to see history of you borrowing and paying stuff back. So I tell people all the time, get a card open, go out and put $10 to $20 on it, which is nothing, and then that's going to show that you're using the card responsibly and give you those points. And then new credit, they don't want to see you opening a lot of new things. So you're trying to get a house soon. That's a big mistake people make. They want to go buy the furniture before they move in. They want to go buy the appliances before they move in. I see people that once they get their credit starts creeping up from the mid 500s into the mid 600s, they go brand new, before they buy their house, not realizing that new credit, now your scores are going to drop 30, 40 points because you just opened this huge loan that the credit agencies don't know if you can afford that yet. So they're not going to give you those points back until you make 3, 4, or 5 plus payments on that car. So huge mistake people make is opening brand new accounts without talking to their credit advisor or their lender before they do something.
Really quick, because you just kind of sparked a question I've always had with car loans. Say hypothetically someone was in a situation where they could afford to buy a car in cash, but they also need to build their credit score. Is it worth it at all to get the car loan, but then pay it off like even quicker than the installments are set up?
No, it's not. So what they're looking at is the payment history. So they want to see an account that's been open for a while. The longer, the better. So if you're just opening an account and closing it, you're opening a new account, which could drop the scores. And then if you close something out, it eliminates the payment history that was on your credit as well. So there's no real advantageous to doing that.
So as soon as the loan closes, that doesn't show up on payment history anymore?
It's eliminated. It's not being factored into the scores. No.
Interesting.
So I had a client this week. Again, all this stuff comes up on a daily basis with me because I talk to clients all day long, and I review credit reports all day long. And the guy, he thought he knew what he was doing. He's like, I'm doing this. He's going 100. I said, sir, you're going 100 miles an hour. He's like, I'm like, don't pay your car loan off. You've had it open for over 5 years. It's a 6-year loan. So
Yeah.
it's like it's been reporting for 60 something months, but he's down that last couple thousand. He thinks that just paying that off is going to help his credit, or actually he'd eliminate that 5+ year history. So I told him, don't spend money there. Spend the money paying your credit cards down below 30%. Let's maximize your score. And once you get your house, go ahead and pay your car off. Do what you got to do.
It's one of those interesting push and pulls, right? Because if you're looking to get approved for a home loan, it would be really tempting to pay off that car loan because it'll help your debt to income.
Yep,
But
definitely.
it doesn't necessarily help your credit. So
It's
it's
not
kind
going to
of,
help your credit. Yeah.
yeah, it's a weird push and pull.
In the debt to income, I mean, and that's why you want to maximize when you're buying a house. Start early. I touched on it right when we started this today, but it's preparation, not panic. That's
Right.
People start doing the wrong things when they're in panic mode and they have to buy something 45 days from now, or their lease is up July 1st, and they're just coming to me today saying, I have to move July 1st. It's like, well, you haven't fixed your credit yet, and you haven't found a house yet. It takes time to close. I mean, now they kind of start doing all these things that they start making a lot of mistakes. So, we could go through that a little bit too if you want, some of the big mistakes people make.
Yeah, let's talk about some of the common mistakes that you see. I think that would be interesting for a lot of people to hear.
Yeah, definitely. Number one for sure, like I said, is racking up credit card debt. So the mistake I see constantly is they start overusing their cards. I would say over half my clients, it's either they're overusing their credit that's available to them for credit cards, not thinking that it's hurting them when it's really impacting their score greatly, or sometimes they're going out and just paying the card off before they go buy a house because they're trying to get rid of debt. Like you said, they're trying to pay off different things for debt to income, not realizing that could disqualify them on the credit side. So I tell people when they're going to buy a house or get, ready to get a mortgage, never close anything unless you talk to your lender. Don't close credit cards for sure. Keep those open, to have those good long-term trade lines, even if you pay them off, and, don't cut them up either. I have clients that say, I'm going to cut them up once they're paid off. You're going to want to use them every couple months. I don't care if you go out and put $10 on it. You want to show that it's actively being used every few months, or those credit card companies will just close them on you sometimes without telling you. And then you lose a 5-year, 10-year history like that. And they don't have to ask you, they just do it. So it's like, that's a big mistake people make.
The credit bureaus, when they're looking at it, you mentioned just using it a little bit per month, but are they looking for you using it a certain amount of times per month or a certain amount of times a year? What are they looking at there?
They just want to see it at active. So, I mean, you don't need to use it multiple times a month. Just once a month is fine. If you did it every other month, I think that's good too. I just wouldn't be only doing it a few times a year. I'd be trying to use it on a monthly basis if it was me. I want it reporting every month that it's active with a very low balance. So, because if you keep a low balance, it's even better than just having it at zero potentially too. So,
okay.
But
one of the other things I've seen credit people recommend, and I don't know how often you use this, is it's kind of counterintuitive, but asking the credit card companies to raise your limit. Have you seen that help people out before too? Because it makes the utilization look a lot better.
Yeah, that's good advice. I mean, there's nothing wrong. It doesn't hurt your credit to raise your limits, and it's only going to help your credit utilization. So I would do that whenever you can. I mean, typically once every 6 months or a year, you're allowed to ask. They're going to look at, has your income changed? Have your bills changed that you have to pay? Really, has your credit changed? That also is a factor of what's going on. But I would definitely say if you can get an increase, do it. I mean, that's only going to help you and give you more buying power to keep you below that 30%.
Obviously, not using the whole credit limit, but
yeah,
anything like that. You mentioned earlier too, mix of credit that's available to you. How often are you using that as a tool, or is it mostly just focusing on paying down the credit cards and clearing up collections that have happened?
Yeah, I would say the biggest things I'm not the mix of credit is really not a huge thing I'm focused on. I'm just making sure that we have enough revolving lines of credit. Meaning, do you have charge cards that you're using? Because that's I'm not going to say go out and open up a new car loan or go get a new loan somewhere. Most people already have a few of those. The
Okay.
one thing you can do if your credit file is very thin or you just don't have really much on your credit, I saw this the other day with a lender, where the person only had, I think, one or two credit cards. They didn't have a mortgage. They didn't have an auto loan. They didn't have student loans, which a lot of people have one of those things, but they had none. They just had like one credit card open, and that was it. And so, what I advise people then, if that's the case, it could be beneficial to go out to there's third-party sites out there. You can go online and find them, but you can report your rent, you can report your phone bill and your utility bill. Is that going to help every version of credit scores? A lot? No, but it could if it's a thin file because they can backdate that stuff 24 months to show, hey, I've been paying my stuff on time. And with new versions that are now released and being used by some lenders, like the Vantage 4.0, not to be confused with other Vantage scores on Credit Karma and other websites, the new 4.0 that's being used by some lenders for home loans, they are taking into effect rent payments and utility and things like that. So it's never going to hurt you to add potentially backdate stuff that you've had open for a long time. I wouldn't say go out and open a brand new cell phone to build history, but if you have stuff already, which everyone does, you can pay a very small amount, I think, per month, less than $10 to have that reported, while you're trying to get your mortgage and keep the credit scores. That might help them.
Okay. And yeah, we could talk about that really quick since you brought it up.
Yeah.
How many lenders have you seen started using that new credit score option?
Yeah. So typically for as long as I've been around, it's always been the FICO score. They've had a monopoly on the scoring model. So two guys way back in the day, 30, 40, 50 years ago, two guys, it's a Fair Isaac. Those are their last names of the two gentlemen that developed the credit system. They started the FICO company. So the Fair Isaac company, that's what FICO stands for. The two guys who invented it, their last names start with F and I and then company, CO. So they have this monopoly. They developed this that the credit bureaus started using, and then government agencies that do, conventional home loans, and then, back those programs, Fannie and Freddie, that back the conventional, and then the FHA loans as well. They started using these as a baseline, saying, hey, we're going to start taking the middle score of these FICO versions that were created. So those have been used for the last decades. Now, recently, the government came in and said, we need to have some competition with FICO to make this more of a fair playing field for consumers. So Vantage 4.0 was created by the three credit bureaus. So they started a company together, a group together, and said, let's create a version of Vantage 4.0 specific for mortgages, not confused with just credit monitoring and stuff like that. So they rolled out 4.0 that was approved by the government, a lot of the government agencies for home loans, just here this year, at the end of last year and this year. Now, no lenders were using it yet because they were testing it. They're backdating it. They're looking at files from the past decade to see, is this new model increasing scores or declining scores, making it harder for a consumer? And the answer is both. So it's not an easy answer. It's not.
That probably means that it's doing about the right thing then. I mean,
yes. So it's going on more of what is your credit file look like? People that what they're seeing so far are very limited. There's very few lenders using it, but some scores are higher if it's a newer credit file, meaning you don't have decades that you've had credit cards open and, student loans open and mortgages open. If you're a pretty new credit file, the Vantage 4.0s are they're going higher, I think, than the FICO scores in general, not always. If you've had stuff open for a while, your FICO scores are probably still remaining higher than the Vantage. So it's like, they're not going to tell us the exact algorithm. It's their proprietary private information. They're just giving us the basic nuts and bolts saying, okay, here's the things that make up our score, but they're not giving you every little detail. So, lending companies now are back testing this for years and years and years and a decade to go, what does this look like? Does this increase the risk of these borrowers for us, or is it not? That's why I don't think it's been rolled out completely to all lenders yet, because everyone's still analyzing, are we okay with this, or are we creating more borrowers that maybe shouldn't buy houses?
Right.
By rolling out a much easier scoring system. So the answer is it's helping him. It doesn't help or hurt you. Usually you can get a version of both, and go, potentially go with the one that helps you the most.
And then you kind of mentioned it a little bit too, but I think this is kind of a fair warning for people that feel like they have a good feel on their credit because of tools that are commonly on credit card websites, banking websites and stuff like that, or Credit Karma. I'm sure you've had a ton of clients come from there thinking that their credit score is at X,
Crazy.
but really it some credit bureaus might be reporting it way lower.
Yeah. So here's the part that you got to be aware of is that happens to me all the time, and all the scores are correct. That's what I always tell people to kind of settle them down. They're like, I'm on Credit Karma. Now my lender pulls this. They're angry at their lender. So I tell them, don't be mad at your lender. They're using the models that they have to use by regulations, which is the FICO 2, 4, and 5 by the 3 bureaus, or some of the lenders now, the Vantage 4.0. The ones you see on Credit Karma are Vantage 3.0, which again were created by the credit agencies, just to have something to monitor credit for consumers in general. But think of it like this: if I was going to lend you $1,000, would I want to look into your background a little bit more to see if you can pay me back for $1,000, or would I look into your background a little bit harder if I was going to lend you $500,000?
Right.
It's like, I'm going to give you $1,000. He could probably get me back. I'm going to give him $500,000. I want to know a lot more. I want to see a lot more history in the past multiple years, at least, of your paying back. How you've been able to pay people back. Do you pay your credit back? Do you pay your loans back? Like, I don't want to see a lot of times that you didn't pay someone back if I'm going to give you $500,000 compared to $1,000 or $5,000.
So that Vantage, that's what like credit card companies are using to decide if they want to give you a credit card.
It could be Vantage. A lot of them will look at FICO 8 and FICO 9. Again, I don't want to confuse everyone on here today that are going to watch this. There's so many versions. Even FICO has multiple versions. But FICO 8, which is on my Citi card, which is on my Chase card, they're giving me FICO versions, but they're not the mortgage versions. These are just general consumer scores that they're using for credit card decisions. Will I give someone this credit card? Well, I'm only going to give them a $5,000 limit. So let's make the requirements less stringent, and make the scoring a little bit easier to qualify some more people. So they're not borrowing, a credit card's not borrowing me 100 or 500,000. They're just going to give me, a few thousand to start.
In most cases, is the mortgage one lower then?
Yep. So the mortgage one, I would say in general, and again, each file is different based on what they have on it. In general, I'd say it's typically 30 or 40 points lower than the Vantage scores or the FICO 8 or FICO 9 that they're using on credit card apps. Banks use those different versions. Credit Karma uses Vantage 3.0, which is just a credit monitoring. And again, I'm not mad at those scores. I think everyone should be looking at their credit score once a month, especially if you're buying a house. You should be very aware of something that could have happened, or your balances got a little bit too high. You should be looking at that once a month, which is now very easy to do. You can do,
because even if you're monitoring it, even if you're using that one that's higher, you can see it going down or you can see it going up. And in general,
100%. Yeah.
Something good.
And in general, if a Vantage score goes from 550 to 650, right? Let's say it goes up 100 points and you're monitoring your score and working on your credit. Your FICO score has also probably went up a very substantial amount as well, but they're not going to be the exact same score. So let's say your Vantage score goes up to 680s. And you're like, oh, I'm a 680 now. You're probably around the 640s, which would still qualify you for a conventional home loan if you're over 640 or 620 in some scenarios. So you're still good. You're just, the FICO scores for mortgages are going to be lower because they're weighing payment history much more than the other companies are. Payment history is the most important. Like, are you going to pay back your loan? They're looking at your past credit history to say, does he pay back his loans or she pay back his loans? That's, once you kind of break it down, it makes a lot more sense. But in the time, people, again, panic mode. I got to buy in 2 months, freaking out at people and at these companies like, this is BS. My scores they're supposed to be 680. I've been watching them. It's like, oh, well, I'm at 640. It's like, well, you're actually at 605.
Yeah.
But there's 5 collections on your report we could work on. There's credit cards that we could add or pay down. So that's where it comes back to, when you're 90 days or probably 180 days, a half of, 6 months out, you should start looking at these things and get advice from a credit, advisor, get them on your team, get a free review done. And then, the steps where, okay, if my online scores aren't close to 700 or in the upper 600s, you better start working on them if you want to get a house.
These are tools that a lot of lenders have as well, too, that they can give you kind of an idea. And it's always nicer to talk to an actual credit specialist when analyzing stuff like that, too, especially if you need to go the extra step in getting someone's help in how can we pay off the collection? How can we get this settled and everything like that? Having experience from someone that does this stuff a lot helps a ton. Do you want to talk about really quick before we get into the last topic? When a lender is taking an app from a couple, how do they assess their credit scores? How do they pick? Is it a combination of both the credit scores? Is it the highest of one of them, the lowest of one of them?
Yeah, and I always like to deflect those questions typically to lenders, but what you want to do is they're going to look at the lowest middle score when the people are applying. So if there's a husband and wife, and the wife has a middle score of 675, and the husband for some reason has 5 collections or doesn't have credit cards for some reason or some stuff happened, and he's at a 585, significantly lower, they're going to take that middle score of the lower of the two. So that maybe doesn't seem fair, but that's what the regulations are. So it's, if you're married to someone or you're going to buy a house with somebody or whoever that may be, you definitely want to know those things because that's going to affect you financially when it comes to buying a house. So the big thing is yes, talk to lenders. They know a good amount. They can help you, give you basics with credit. But if you're trying to fix credit, that's when you really want to talk to a specialist because there's a rating system that I would say 90% of lenders don't even know. The rating system that rates each item on your credit report. It's called the MOP rating system, and I won't bore you to death with that. But if you pay stuff on time, it has a +1 rating, whether it's an installment loan or a credit card, whatever it is. Now, anything outside of that now goes through a rating from a 2 through a 9. So if you're 30 days late, it's a -2 rating, drops the scores. If you're 60 days late, it goes -3, drops the scores significantly more. -4, -5 is 90 days late, 120 days late. After you're 120 days late, typically around the 150-day mark or 5 months, they're going to go to collections and get a -9 rating on the credit report. That's when you see the big drops, of having a brand new collection. So, not all collections are created equal. If you have a new one, that hurts you way more than one that's been maybe sitting on there for 2 or 3 years. So if you're trying to fix stuff, you got to talk to a specialist that understands the rating system. And that's what you got to start working on is get off as many negative ratings as possible. So you're helping your payment history, which is the most important. And then in the meantime, you have a credit specialist that's going to help you budget. They're going to help you spend every cent in the right area. Is it more important to pay down this X, Y, and Z card? Or is it more important to pay this collection or do a settlement with me where I can save people 40, 50, 60% off maybe what they owe and get the item deleted? Well, now that -9 rating is gone because the settlement was done where the company's going to delete the item.
So it just completely comes off your credit report once it's settled and collected and everything like that?
Yeah, so there's another thing that the most important thing I think for what I do is knowing companies that are willing to remove the item and which ones are not. So it's not a law unless it's a medical debt. All medical debts, once they've been settled for less, whatever the agreement is, and paid. Let's say you have a $1,000 medical debt. If it's paid in full, of course, it goes to zero and it has to be removed within 30 days by the credit agencies. That's a law a federal law in 2023 that started. You can also settle your medical debts for less. Let's say you settle for 500, 50% off, and they agree to that and they zero out your account. Once it's zeroed out, the agencies have to take it off the report. Now that's just medical debts. That's a big amount of people's debts, but there's tons of other debts on their collections. Old cell phone bills, utility bills, all types of things. Old credit cards that have been closed out and then sold to collection companies. So there's a lot of companies that do collections that will remove your item, but you got to know which ones. Just paying an item is the number one biggest mistake I see when it comes to credit repair. When people try to do it themselves, a horrible idea, because if you ask them, do you know the rating system? 99.9 are going to say no.
Yeah.
So how are you going to win the game if you don't know the rules in anything, let alone financial credit repair? That's just.
Well, I'm sure there's a ton of people that don't even know, like, a lot of these companies, once they've sent you to collections, those companies that are buying that debt to make a collection, they're buying it at a discount. So they're more than willing to make a deal as long as they're making money. Like, so I think a lot of people just assume, like, well, this is what I owe. Eventually I have to figure out how to just pay that off. But if you're
I see it every week. Someone comes to me, they pay off these debts. They're like, oh, it was $200. I paid it the other day. These are the panic clients that are always doing this again. They got to close early, it feels like. They're like, I just paid this $200 one. I paid this one for $400. I'm like, did you do a settlement? They're like, no, I just paid it off in full. I go, did you ask them to remove the item or even look at if they would? No, I didn't. It's going to come off, of course. I'm like, that's not true. And then here's what happens. If you pay a collection that they don't remove because they don't have to by law, unless it's medical, that will update what's called the date of last activity for 7 more years. So
wow.
you might have had a debt that was sitting on there for 3 or 4, healed. It's not hurting you terribly. You pay it in panic mode. It goes to zero. You think it comes off. It doesn't. Now you refresh that new item. It looks like a new collection just hit your account. Now you actually just dropped your credit score by doing something you thought was good. So for me, what kind of wrapping stuff up, it's like, we're going to do the review. I'm going to educate you on all these things so you know exactly what makes up credit scores, what the process you should be focused on. Do you have to pay down cards, which ones and how much, or do you have to open ones or be added as an authorized user? What's the best options? That's the simple part. Then step 2 is let's go through bullet point all these items on your credit report. Let's go through these 7 items and what their ratings are. Are they yours? Do you agree with them? Should we challenge them? Do you not know what they are because they've been sold off 3 times?
Right.
Disagree with the medical, some debt that shouldn't be on there. Sometimes those get removed by challenging them with the agencies if they're not correct. Then the most important part, by far, whatever's left, whatever debts are yours, because most likely most of them are, I'm guessing, is doing a settlement and doing them where it's going to be worth it to your score and to your money. Because just paying anything just to pay it does not delete it. They don't have to do a deletion unless it's medical. So you got to have an expert. If I'm making calls and help people with that stuff on a weekly basis, all types of companies that will like to do type of deals. If you're just a random person off the street, you might be calling people, verifying your debts and refreshing your debts just by calling them.
Oh, wow.
People are making all types of mistakes. So to fix credit to me is
that's just if it got to the point where it's sent to collections, correct? Or is that
what's your question more specifically?
Yeah, like you owe company X money and then they sold the debt to a collection company. That's when it gets to the point where you got to start knowing the ins and outs of this company will take a settlement and this company will wipe the debt up. Yeah.
If it's with an original bank, like a bar, I'm not going to get into the names. Let's say the big banks in the United States, right? But if it's with an original creditor, most of the time they're not willing to delete it.
Yeah.
So you going off and paying this old credit card that's still with a huge bank, that's probably not going to delete that charge off. So, you might be better off just letting that heal on there or doing it after, take care of it after you've got your loan and done everything else, before to maximize your score. You got to learn how to maximize and play the game. And to do that, you got to know the rules. Because when you're fixing credit, you're building your financial status. It's your financial report card. So if you don't have good credit, you could be the same. Me and you could be neighbors, and I could be paying $15,000 more for a car because I have bad credit.
Yeah,
you have the same car. I could have worse credit and get an interest rate that's in the teens compared to a lower. You might be paying half the interest rate for your auto loan because you have better credit than me. And then on the house, you could be paying tens or hundreds of thousands of dollars more over that life of the loan because you had less of your credit score. So people think like, oh, you pay a few $100s to get your credit fixed. It's like, it's tough. I don't really want to spend a few hundred. You're going to save that over the course of your life. I mean, significantly.
Well, yeah, over the course of your life, because you'll be saving money. I mean, people are so interest rate cautious right now when they're purchasing.
Yeah, definitely.
And this is a cheaper way to get an interest rate improvement than buying a fixed rate buy down or talking the seller into giving you a buy down and everything like that. I mean, you can improve your interest rate just by improving your credit score, and it's super, super simple.
I had someone the other day as a good example. They were in the upper 500s. They had 3 collections. We got those removed. Now they're in the lower 700s. Guess what? They probably saved $500 or more, $500 to $800 a month on their mortgage, maybe.
Yeah. So they got the money back basically right away. And on top of that, you probably saved the money on a settlement that they didn't know was there and everything like that.
Yeah, you could save them 40, 50, 60%. And that happens all the time. Where it's like they owed $1,500. Well, now they just paid $700 and saved $800 and it's off their report. I mean, it's a win-win all the way around to pay a few $100s to have an expert. So to do it on your own, you're playing a financial roulette. You know what I mean? Yeah. Like you're spinning the wheel and just praying that it happens.
And you're putting a lot of time and mental energy into learning how to do something I talk about it all the time with people with using me. Like you could just call an expert and have them walk you through the process and make it way more stress-free, and set up a clear game plan and everything like that. The other thing that I think is interesting that comes up a lot from home buyers and everything like that is they're always really, really worried about the hard credit pull. And I know that you shouldn't just do it willy-nilly, but do you want to talk about how much that actually affects people's credit score and if it's even a difference that people should be cautious about?
Yeah, so I tell people all the time, before you start, doing hard credit, a soft pull and a hard pull are completely different. If you do a soft credit pull, that's just a consumer check like you would online. So it's not going to hurt you to look at your credit card app, your banking app. There's other websites out there. You can pay a very small monthly fee, which I recommend, to look at your credit or at least check it every so often and then get that consumer score. That doesn't hurt you 1 point to check that on a monthly basis. So do it. Now, if you're interested in getting a home, you're going to have to do a hard inquiry when it comes time. So you want to make sure that you've looked at your credit, you talk to a credit expert. Have I maximized everything possible before I go down this rabbit hole of, having to do applications and stuff. And then at that point, if you have to do a hard credit pull, it's going to impact the score of 3 to 4 points. So it will drop the score of 3 to 4 points. Those hard inquiries stay on there for 2 years. So if you're going to go out and get a house, be serious about it and be ready, so you definitely want to make sure that, you have your ducks in a row and you've done everything you can do before you start that process. They can use that report for a few months, but you want to make sure that you're not re-pulling it every 30 days because now you're dropping your score 3, 4 more points. If you're going to go get an auto loan, I think it's 48 hours. So you can go to multiple dealers and have your credit pulled. It'll look like, or they might shop it out to try to find you the best interest rate ranks. It looks like 10 hard inquiries, but it only hurts your score once.
Right. So, if it's all within that 48 hours.
Exactly. So if you're going to do it,
for home purchase, it's like 21 days, isn't it? 14 days, 21 days?
14 to be safe, sometimes 30, but with 14 days for mortgage stuff. So it's like, I would say 14 days is a good thing to go by. So don't be pulling credit, every few weeks, like with your lender. If you pull credit with the lender and it's like, hey, sorry, your FICO score is not where it needs to be, wherever that is not qualifying you for the loan you want. That's when you talk to a credit expert like myself. You figure out the game plan, you get it up, you use the credit monitoring scores to see, hey, I have increased my score 50 or 75 points in the last couple of months. Let's go now. I'll go to the lender and say, I think it's smart based on what I'm seeing to re-pull credit. You should be good to go.
Good. That is really, really
great. There's a good, the realtor, myself, the lender, we're all one team. That's really the financial team that's looking out for the best interest for the client. So that's the most important thing, is being on the same page. A good lender, realtor, and credit expert should be on the same page, so you know what to do. Yeah, I know you probably don't want to be going out showing people houses for months on end, all to find out that when they do the hard credit pull, that it's a 560 and they can't qualify for anything unless they have 10% down, which they don't probably.
Yeah, nothing makes me roll my eyes more than lenders that send out pre-qualifications and it's based off of stated income, and they haven't pulled credit yet.
Yeah, it's a bad lender.
Yeah, and they haven't verified cash assets, so it's like we haven't really done anything. Like, we have a rough idea of their debt to income. We have a rough idea how much they make, but we don't know what the credit score is going to come in at, and we just don't know what credit is yet. So it's better than people just going out and looking at houses before even getting approved, but
definitely.
It's not very valuable at all. But hey, I think this was some really great information, and I think you gave people a really, really good idea of how they should look at reaching out to someone like you. So I really, really appreciate it. Was there anything that you think was important that we missed talking about that are common misconceptions in the credit world?
I don't think so. I mean, if you have more questions, let me know, and I can go through. We can take a look at your report or answer any specifics. But like we said, if you're getting a home buyer ready, the main things are no late payments, which get everything on auto pay. Look at your credit card utilization. Make sure everything's below at least 30%, and that you have at least 3 cards, so you have a good mix and you have ability to get those utilization points, because it's such a big piece. 2, get rid of as many -9 items or negative items like collections on your credit report using an expert. Of course, don't just start throwing money at that. Those are the biggest things. I mean, that's typically the number one stuff you want to look at is, make sure that stuff's handled. And then, you're in a pretty good spot. You've maximized your score and you're probably home buyer ready at that point, but no matter where you're at, you can do it. I mean, I tell clients all the time, you can do it. I've seen clients that are in the upper 400s and low 500s. They can get to 580, 620. They're not getting to 700, for years, but they can get to 580. They can get to 640, which sometimes they don't even realize that gets you a house.
Yeah. So, and a lot of times too, if you're doing all that work with them and they are actually serious ones that are doing that type of improvement that you said you can see in 30, 45 days, after they're even done with you, they're probably on the right path to eventually get up to that 720, that 740.
Yeah, they can get there at some point. It just sometimes it takes time for late payments, a couple of years for their late payments to heal. They got to let some of the collections that are going to be on there that might not get deleted have to rest for a while. But that doesn't stop you from being a homeowner. So that's what people don't realize. You can have a few collections and still get a house. It's possible. So don't think a big misconception is I have collections, I can't buy a house. It's like, that's not true. People don't, you don't have to be in the 700s or like, I don't have an 800 credit score. Yeah, barely anybody does.
You have to wait a while, but even if you have a bankruptcy, you can still eventually buy a house later on. I mean, it's all possible.
And I won't get into that, but I mean, I help a lot of clients after they have a discharged bankruptcy. They're usually, all those items are -9 rated collections or charge-offs that are zeroed out. Well, you can get those updated to a -7, which doesn't sound great, but that helps your credit score. So I see clients all the time. Once, a couple of years after bankruptcy, once it's discharged, you should start working on rebuilding credit, getting some new secure cards opened up, build new trade history. All of a sudden you can pop a mid-600 score and get a house again.
Yeah.
So if you've got your life financially, you just can't be making the same mistakes over and over and over. But
thank you, Peter, so much for joining. I appreciate your time. And anyone that is watching, I am going to put Peter's information in all the comments of all the different places this is live streamed if you want to reach out to Peter for any help or just reach out to me and I could get you in touch with him. If credit score is something that you've been worried about, whether you're trying to purchase a home or just worried about in general and want to improve it, I think Peter would be a great resource. So thank you so much and have a great day.
Yeah. We'll see you. Thanks for having me.
Thank you.